Hello everyone, welcome to Online Money with Peter. Kindly stay tuned. Forex trading offers the potential for impressive results, allowing you to achieve significant gains in just 1 hour or less each day, regardless of your location. One of the most appealing aspects is the ability to trade with substantial amounts of capital, often hundreds of thousands of dollars, belonging to others, all while minimizing your own risk. Once you master the art of trading, it can provide you with unparalleled time, location, and financial freedom compared to other career paths. In this comprehensive course, I will guide you through everything you need to know to embark on a successful trading career, regardless of your prior experience. I will walk you through the entire process, starting from the fundamentals of Forex to executing your first profitable trade. You may be curious about my qualifications and why you should trust my insights. I have been trading for 7 years and have established a career in this field. Over the past 2 years, I have trained more than 2,000 individuals, collectively achieving an impressive $21 million in results. Many of my students are now earning over $10,000 per month, with several transitioning to full-time trading. Now that we've established my background, let's dive into the lessons. So what exactly is Forex? Forex, short for foreign exchange, refers to a vast global market where the values of different currencies are traded against one another. Unlike stock trading, where shares of companies are bought and sold, Forex involves the daily trading of currency values. With approximately $7 trillion exchanged daily, it is the largest financial market in the world. Additionally, Forex is the second most flexible market after cryptocurrency, operating 24 hours a day, 5 days a week, allowing you to trade at virtually any time, except on weekends. In the realm of trading, the Forex market offers unique advantages compared to stock and futures markets, primarily due to its lack of specific trading hours. While stock and futures markets operate within defined time frames, Forex trading is available around the clock, allowing traders to execute trades anytime from 10 p.m. Greenwich Mean Time on Sunday to 10 p.m. Greenwich Mean Time on Friday. It is important to note that the market is closed on Saturdays and Sundays. So what exactly do we trade in Forex? We focus on the value of various currencies, but rather than purchasing physical currency, we engage in trading contracts known as currency pairs. These pairs represent the value of one currency relative to another. A common example is the euro to US dollar pair, which compares the euro to the US dollar. There are hundreds of currency pairs available, categorized into 3 main segments: major currency pairs, minor currency pairs, and exotic currency pairs. Major pairs include the most significant currencies and always feature the US dollar. Examples include euro versus dollar, British pound versus dollar, dollar versus Japanese yen, and New Zealand dollar versus dollar. Minor pairs consist of important currencies that do not include the US dollar. Some examples are euro versus British pound, New Zealand dollar versus Japanese yen, and Canadian dollar versus Swiss franc. Lastly, exotic currency pairs consist of one major currency and one from an emerging market. An example is dollar versus Mexican peso. Generally, it is advisable to focus on trading major pairs, as they tend to have the highest trading volume and liquidity. In the context of trading, the euro to US dollar currency pair consists of 2 components: the base currency and the quote currency. The base currency is always the first one listed, while the quote currency is the second. The price of the currency pair reflects the value of the base currency in terms of the quote currency. For instance, if the euro to US dollar price is 1.08538, this indicates that 1 euro is equivalent to 1.08538 US dollars. To profit from trading, the price must increase after a purchase at this level. For example, if you buy at 1.08538 and the market rises to 1.09538, you would realize a profit. One significant advantage of trading Forex compared to other markets is the ability to trade in both directions. When you buy stocks and their value declines, you incur a loss because the shares you own decrease in worth. In Forex, however, you are trading contracts, allowing you to speculate on whether the market will rise or fall. This means you can also sell the market and profit when it declines. Familiarizing yourself with key terms is essential in Forex trading. Bullish refers to a market that is rising, and it describes a positive outlook. If someone is bullish on euro to US dollar, they believe the pair will increase in value, even if it is not currently doing so. Conversely, bearish indicates a declining market and a negative outlook. If euro to US dollar is bearish, it suggests that the pair is expected to decrease in value. Lastly, the term long refers to a buy position, meaning you are taking a trade with the expectation that the price will rise. To generate income through currency trading, one must accurately predict the movement of currency pairs and then execute trades accordingly, either buying or selling based on the anticipated direction. For instance, if you believe the euro will strengthen against the US dollar over the next 10 minutes, 10 hours, or even 10 days, you would take a long position by purchasing euro to US dollar. Conversely, if you expect the euro to weaken, you would sell euro to US dollar. A significant advantage of Forex trading is the flexibility to operate across various time frames, allowing you to enter and exit trades within minutes or hold positions for extended periods, even years if desired. Different trading styles correspond to varying time frames, including scalping, day trading, swing trading, and position trading. Scalping involves making quick trades to capture small price fluctuations, typically within seconds or minutes. Day trading focuses on entering and exiting trades within the same day, while swing trading aims for larger price movements over several days to weeks. Position trading, on the other hand, involves holding trades for months or even years. Among these methods, day trading and swing trading are the most prevalent. I recommend starting with swing trading, as it is the most straightforward and least demanding approach. This style is particularly suitable for individuals with full-time jobs or other daytime commitments, allowing you to trade without significant disruption. Swing trading is also easier to master and can yield substantial profits. By identifying a trade, entering it, and allowing it to progress over a few days to weeks, you can potentially earn thousands of dollars passively. How to make money trading? To generate income through trading, the primary objective is to identify a market that is trending either upward or downward. A trend refers to a period in the market where prices are consistently moving in one direction, rather than remaining stagnant. The Forex market offers significant flexibility, allowing traders to engage in positions without the need for long-term commitments. For instance, you can enter a buy position during an upward trend, and if the market begins to reverse, you can exit and take a short position to capitalize on the downward movement. Understanding pips is crucial, as they measure the price fluctuations in the market. The currency quote previously mentioned consists of pips, which represent the price of a currency pair. For example, in the euro to US dollar quote of 1.08538, the digit 3 represents 1 pip, 5 represents 10 pips, 8 represents 100 pips, and 0 signifies 1,000 pips. The final digit, often a small fraction, is typically disregarded when counting pips, as we focus on the whole numbers from the left. Pips play a vital role in preparing trades and managing risk, and we will explore this topic in greater detail shortly. Technical analysis. Technical analysis is a key method for forecasting market movements and identifying potential trades. It is advisable to start with this approach, as it is the most widely used and easiest to understand among traders. Technical analysis involves utilizing price charts to predict future market directions by examining patterns within those charts. Fundamental analysis. The second type of analysis is fundamental analysis, which involves evaluating political, economic, and real-world events, along with news and data, to determine market trends. While fundamental analysis can provide valuable insights, it is not a necessity for trading. As a beginner, it may be more beneficial to focus on technical analysis initially. Risk management is a crucial aspect of trading, as it involves making informed decisions about the potential direction of a currency. Traders often face the reality that they will be incorrect in their predictions, with many successful traders being right only about half the time. For instance, if a trader executes 10 trades, they can typically expect to win 5 and lose 5. The key to trading success lies in effectively managing both wins and losses, rather than attempting to eliminate losses entirely, which is an unrealistic goal. Understanding that losses are an inevitable part of trading, it becomes essential to implement risk management strategies. This includes selecting trades of appropriate size and being ready to exit losing positions early while allowing winning trades to run until they yield substantial profits. To begin trading, you need to familiarize yourself with three essential components: a broker, charting software, and a trading account. A broker acts as an intermediary between traders and commercial banks that execute trades. When you place a trade, it is typically processed by a bank, but direct access to banks is impractical for most traders, as it requires significant capital or licensing. Instead, trades are executed through a broker who manages the process on your behalf. Choosing a reliable broker is vital, as some may engage in unethical practices, such as denying withdrawal requests or imposing excessive fees that can diminish your profits. Throughout my 7 years of trading, I have consistently used a trustworthy broker without any issues, and I have included a link to that broker in the description for your convenience. What is commission? Commission represents one of the primary methods through which brokers generate revenue. It is a predetermined fee that brokers impose for facilitating entry and exit from trades. Notably, commissions are not applicable to every trading account. However, I tend to favor accounts that do incorporate commissions. Typically, accounts that charge a commission feature narrower spreads, allowing traders to choose their preferred payment structure. You can opt to pay commissions or incur higher spreads on your trades. Personally, I find commissions to be the more logical choice. Nevertheless, there is no need for concern, as proficient trading can render both commissions and spreads manageable. Lot size refers to the volume of a trade you intend to execute. It indicates the number of units you wish to purchase. A standard lot is defined as 1.0, which corresponds to a transaction value of $100,000 in an asset. To engage in such a substantial trade, an account balance of approximately $10,000 or more is typically required. As a beginner, you will likely be trading in microlots, such as 0.1 or 0.05. Smaller lot sizes result in reduced potential profits, but they also limit potential losses. Conversely, trading with larger lot sizes can yield significant profits quickly, but it also carries the risk of incurring substantial losses in a short time. It is advisable to commence with smaller trades and gradually increase your exposure while adhering to sound risk management practices. How to determine the appropriate lot size? Determining the appropriate lot size for a trade is straightforward. One effective method is to utilize a lot size calculator, which simplifies the process. Numerous calculators are available, and I recommend one from my FX book. By inputting the number of pips you are willing to risk and the balance of your trading account, the calculator will provide you with the optimal trade size. What is leverage? Leverage refers to the funds borrowed from a broker to facilitate trading. The minimum trade size with a broker is typically 0.01 lots, which corresponds to $1,000. To execute this trade without leverage, you would need to have $1,000 in your account. The potential profit from such a trade is limited to a few dollars. Therefore, to generate significant income without leverage, one would need to trade with substantial capital, often in the millions. To address this, Forex brokers offer leverage options. Leverage is expressed as a ratio such as 1:10 and can range from 1:10 to as high as 1:1,000, which can be excessively risky. For instance, 1:10 leverage allows you to trade with 10 times the capital of your account, while 1:100 allows for 100 times the buying power. In my view, leveraging beyond 150 is unnecessary, as it increases the risk of losing more than intended, which contradicts sound risk management principles. Ratios of 120, 130, and 150 are generally advisable. It's important to note that leverage is not a line of credit. There are no interest charges or penalties associated with its use. It is a standard feature of Forex accounts, and brokers will automatically close trades if they believe you are at risk of losing your entire investment, preventing you from incurring debt. Therefore, leverage should be viewed as a valuable tool, essential for effective Forex trading. What is margin? Margin refers to the funds you allocate in a trading account to facilitate your investments. For instance, if you deposit $10,000 into a trading account with a leverage of 130, you effectively gain $300,000 in buying power, allowing you to open positions up to 3 lots. However, your margin remains at $10,000. meaning the broker will not permit losses to exceed this amount. Should the broker anticipate that your losses might reach this threshold, they will issue a margin call, prompting you to deposit additional funds into your account or risk having your positions closed. It is crucial to avoid reaching this point. Your objective should be to steer clear of margin calls throughout your trading career. Margin calls typically arise from poor risk management, so adhering to sound risk practices is essential for maintaining your capital. How to set up a trading account. Now that you have a grasp of brokers, the next step is to establish a trading account. You have two choices: a demo account or a live account. Initially, a demo account is advisable as it allows you to practice trading with virtual funds. This means you can learn and develop your skills without the risk of financial loss. A live account, on the other hand, involves trading with real money, where you can earn actual profits. Once you feel confident in your demo trading, you can transition to a live account. To set this up, visit your broker's website and create either a demo or live account. However, note that you cannot execute trades directly on the broker's website. You will need a trading platform for that purpose. I recommend using MetaTrader 5. Simply go to your phone's app store, search for MetaTrader 5, download the app, and log in using the credentials provided when you registered with your broker. With that, you will have an active account ready for trading various market orders. There are 5 primary methods to enter a trade. The first method is market execution, which involves clicking the buy or sell button to instantly enter the market. This is a widely used approach and the only way to enter a trade immediately. The second method is a buy limit order, which activates a buy trade when the price drops to a specified level. For instance, if the current price is above your buy limit, you will be triggered into a buy when the market reaches that level, allowing for potential profit if the market reverses. The third method is a buy stop order, which is set above the current price. If the market rises to this level, it will trigger a buy, and you can profit if the market continues to move upward. The fourth and fifth methods are the sell counterparts, a sell limit and a sell stop. A sell limit is placed above the current price, triggering a sell when the price reaches that level, while a sell stop is set below the current price and activates a sell if the market falls through that point. These various entry orders serve different purposes in the market, and while you may not utilize all of them, you will become familiar with several as you begin trading. A stop loss is a crucial type of order that you should implement in every trade. It is designed to automatically close your position at a predetermined loss level if the market reaches that price. Since it is impossible to win every trade, a stop loss helps you minimize losses quickly. This order is beneficial as it allows you to exit a trade without constantly monitoring the charts. Incorporating a stop loss into every trade is essential for effective risk management, so be sure to remember its importance. What is take profit? A take profit is essentially the counterpart to a stop loss order. To illustrate, consider a scenario where you enter a trade at a specific price, set a stop loss at a certain level, and establish a take profit at another. If the price declines to the stop loss level, you will incur a loss of $1,000. Conversely, if the price rises to your take profit level, you will secure a profit of $5,000. Utilizing stop loss and take profit orders is a fundamental aspect of risk management, allowing traders to maintain long-term success. By setting take profits, we can automatically close trades that yield positive results, while stop losses help us exit trades that are not performing well, thereby minimizing potential losses. When determining stop loss and take profit levels, it is crucial to apply a risk versus reward strategy. This approach involves ensuring that the potential gains from winning trades outweigh the losses from unsuccessful ones. For instance, you might set a stop loss $11,000 away while positioning your take profit $3,000 or $4,000 from the entry point. This way, if the trade is successful, your profit will be 3 to 4 times greater than your loss in the event of a downturn. To illustrate, if you execute 10 trades, winning 5 and losing 5, your total losses would amount to $55,000, while your gains could exceed $115,000, resulting in a net profit of approximately $10,000 or more. How much money do you need to trade? To sustain a living through trading, you typically need a capital of at least $50,000 to $100,000, with higher amounts generally being more advantageous. However, for many individuals, accumulating such funds can be a daunting challenge. This is where proprietary trading firms or prop firms come into play. A prop firm is an organization that provides traders with access to substantial capital, ranging from $100,000 to $1 million, if they can demonstrate their trading capabilities. Prospective traders undergo an evaluation process, where they trade with simulated funds and must achieve a modest profit while adhering to specific drawdown limits. Successfully completing this evaluation grants them access to a funded account, allowing them to trade significant amounts while retaining 80% to 90% of the profits generated. You now have a foundational understanding of trading, and your broker and trading accounts are established. The final essential tool you will require is charting software. In this regard, TradingView stands out as the premier choice. Visit tradingview.com to create your account. This platform will be instrumental for chart analysis, technical evaluation, and identifying your trading setups. Trading psychology. Before diving deeper, it's crucial to address trading psychology. Surprisingly, psychology plays a significant role in your trading success. Trading involves creating a set of rules and adhering to them to consistently profit from the markets. However, in a high-stakes environment where you can gain or lose substantial amounts in mere minutes, emotions can easily take over, leading to poor decision-making driven by the stress or thrill of rapid financial changes. Consider this. Have you ever earned $5,000 in just 5 minutes? For many, the answer is likely no, but the mere thought of such a scenario can evoke feelings of invincibility. This sense of overconfidence can lead to greed and ultimately result in poor choices, as traders may feel untouchable. Often, they might gain $5,000 only to lose it just as swiftly. Conversely, have you ever experienced a loss of $1,000 in a single minute? While you may hope to avoid such situations, they can become commonplace in trading, even when using someone else's funds. Such losses can trigger anger and frustration, prompting attempts to recover the lost money, which frequently leads to further poor decisions and larger losses. These detrimental choices, stemming from flawed psychology, contribute to the failure of 90% of traders. Once you have mastered a trading system, the learning curve diminishes significantly. The next step is to master your mindset. Traders who successfully manage their emotions tend to achieve success, while those who do not are often destined to fail. Never underestimate the value of maintaining a calm and composed mind while trading.
Forex trading isn't just a skill. It's a gateway to rewriting your lifestyle. With the right strategy, discipline, and guidance, you can unlock the freedom to earn on your terms from anywhere in the world. My proven framework, honed over 7 years and shared with thousands of successful students, demystifies the complexities of trading and hands you the tools to profit consistently. Whether you're leveraging prop firms to trade with massive capital or mastering swing trading to earn passively, the path to financial independence starts here. Ready to transform your future? Subscribe now for more game-changing strategies, live trade breakdowns, and psychology tips to sharpen your edge. Hit the bell icon to never miss a video. Your next big trading insight could be one upload away. Join thousands of traders in the community rewriting their financial stories.